This is why you should be replacing your trend lines with macroeconomics. So most traders spend most of their time studying candlestick charts. They watch every candle, every wick, every formation, trying to predict where the market will go next. And that's the problem. Candlesticks only tell you what's already happened and not why it's happened. Candlesticks show you the price and not the purpose. Macroeconomics, on the other hand, explains why price is moving. It's the difference between watching the surface of the ocean and understanding the tide that moves it. In this case in particular, I'm on gold right now, and this might seem just like a super basic chart that nobody understands, but all I've done is mark out market structure for me to be able to take longs or shorts based on market structure. So this chart might look super basic to most people, and most might not even understand what's going on here, but it's so basic that it confuses 90% of traders. All I've done is mark out my structure highs and lows, and that helps make up 25% of my trading model, while the 75% comes from my macroeconomics of why the chart is actually moving in a direction. So I don't trade with any liquidity sweeps, I don't trade with fair value gaps, order blocks, nothing of the sort. And I want to make this video to kind of show you guys that there is more out there to trading than what you see on YouTube with all these gurus teaching you about all these crazy terms when they can't even see what's going on inside an actual candlestick. So obviously markets don't rise or fall because of candle patterns. They move because of interest rates, inflation, central bank policies, global capital flows. When the Federal Reserve raises rates, when inflation data surprises, or when global growth slows, these are all real forces that are driving price, and the chart just reflects the reaction. So in this case in gold in particular, you can see that we're already trending. We're on the 15-minute time frame. This is the easiest place if you're just learning swing trading to, get the most action, understand structure and structure shifts very quickly. And I can see that there is a high followed by a lower high, followed by a higher low, this becoming our actual real higher low, and then obviously creating a higher high once these areas right here were broken. So in this case, I have the how. What I'm looking at here is basic market structure. The market is telling me from a chart perspective that we are moving bullish. So this price action is from early October, and this was in the midst of us getting a government shutdown. We weren't sure what was going to happen. There's a lot of uncertainty in that case. So of course, gold is going to be the asset that we're parking all of our money in. It's a hedge against inflation. It is the safest bet. With the economy also slowing down, gold is also going to be going up. I use price modeling software that takes all this stuff into account and obviously gives me a model of which way I should be trading, where my stop should be, where my TP is, and where I should be roughly grabbing an entry. But I can make a separate video on that for you guys. But right now I do want to focus on the market structure bit and why you should be switching to macroeconomics. So we're also very close to all-time highs at this point. We're very keen on obviously hitting those all-time highs from a trader perspective, from an institutional aspect. We all know that gold is just going to continue going higher. Obviously, you shouldn't be saying, yes, gold is just going to keep going higher and that's your analysis, but keeping that in mind in the back of your head is also a very key detail. So with all this in mind, you can understand that macroeconomics gives you a bigger picture. It helps you understand the direction and why the direction is going in that way. You start to see how an asset class reacts and interacts with stuff that's going on in the world, how bond yields pressure tech stocks, how a strong dollar can maybe hurt commodities, or in this case, a weak dollar helps commodities. The knowledge helps you position yourself with the current, not against it. So from a technical trader's perspective, they're trying to predict the next couple candles, and macro traders are the ones focusing on where capital is likely to move next. So if you're a technical trader, you're looking for some sort of pattern, a repeat in market structure to obviously have the goal of predicting where price is going to go. But as a macro trader, I can tell you which way it's going to go based on the published information. And with all the information out there, just using Forex Factory alone, you can easily create your own bias for which way price is going to be moving. I want to move into current price action right now. This is being filmed on October 13th right now. We've already crushed all-time highs, which was right here. We've obviously exceeded those all-time highs. I'm actually in gold longs currently, and that seems to be going very well. But you can see how basic this chart setup is. I have my swing low marked out. We saw reactions from the swing low, not breaking it, but being a complex pullback. Most traders will see this low being taken out right here and call that a break of structure, when I cannot stress enough that you have to identify the difference between a break of structure and a change of character. Right now, yes, we failed to break this high. Yes, we broke this low, but this is the swing low. And I made a short form video talking about swing highs and swing lows, how I identify that, how I can see if I'm in a complex pullback versus when I'm looking at a actual break of structure. I can make a long form video on that actually if you guys want to see that, but for the most part, I'm paying very close attention to that because it tells me exactly which way I should be trading. If I should be shifting from looking long to short, and in this case, I was correct. As of last week, we had inflation expectations drop by 0.1% from 4.7 to 4.6. So obviously that's good and that should signal a stronger dollar, but we're still in the midst of government shutdowns. We had a stock crash on Friday. There is still so much uncertainty in the markets, which is even more of a confluence for me that gold is going to continue rising. We're at all-time highs right now. I'm happy holding this trade for a little bit longer. I'll make a full trade breakdown on this particular position, but I won't be in it for probably more than a couple days. I don't really want to hold this for an entire week, but as you can see, it's just a swing low, swing high, complex pullback right here. Obviously came all the way down. That's probably getting some people ready to go bearish. This is Friday where the market crash was. So obviously, we went long here and then we continued higher, breaking out from all-time highs. I just think right now in terms of asset classes and specifically commodities, that gold is just the best one to be using as a hedge against inflation. I've also do a bunch of reading in my free time on the markets, and even Ray Dalio, one of the biggest hedge fund managers in the world, calling out gold being such a good hedge against inflation as of a week ago. So I assume institutions are very bullish on this still, which means I'm bullish on this still. The whole purpose of this is showing you guys how 25% of my strategy is just the charting to understand and confirm my macro bias using market structure. If you're only looking at candlesticks, you're reading the market's language without understanding what it means. Once you add the macroeconomics, you're reading between the lines and you can see behind the moves. Don't just study price, study policy, study growth, study sentiment. In trading, it's not about the candles that move the market, it's the forces behind them. The candles will tell the story, but the macro is the one writing it. I hope you guys enjoyed this video. I'm gonna start making more of these more often because I'm getting a lot of positive feedback of showing people how you can use macroeconomics and minimal charting to actually take these educated moves rather than looking at price action and trying to call out all these terms that aren't real to me. So I hope you guys enjoyed, and we'll see you guys in the next one.